Yeah. Well, this is Lab 10. We're going to develop a complete financial model for a business, okay, in an hour and a half, okay. This is a precursor of what the lab, about 75% of the points in the lab exam has been in the past, and will be this year as well, okay. This is what Homework 6 is all about. Homework 6 is blank down here where we actually have stubs that tell us what to put in. You can just do that yourself. So what we start with here is input data. The input data is bold and yellow. We have acres owned, acres rented. We have land value, change in land value. Let's see, we also have one down here. Maybe we ought to delete that one. Nope, we've got that one. We're going to use it. Okay, so land value is going to go up 5% a year. We have some beginning cash reserves. We have some base family living that's going to come out. Then if there's any positive net cash income, we're going to take 5% of that for family living. Discount rate for calculated net present value is 12.5%, which is fairly high. We've got depreciation deduction, other income tax deductions, and we have some interest on cash reserves. And what this is, make a note of this, this is the wedge to increase the national interest rate to the local. No one's borrowing, oh, pardon me. Now, that is an interest on cash reserves. We'll use that number there. That comment goes right there. Local interest rate basis, which is saying we're going to pay 5 percentage points more than whatever the national is. We're not considered a good borrower. Okay. We have variable cost per acre, and then we have variable cost to harvest the crop. Okay, this is usually a drying, hauling, harvest cost. We have some fixed costs for the farm. In your homework, they're individual broken out here for fixed costs on the farm. We're going to rent the land for $100 an acre that we rent. And here's a scenario that we're going to be looking at. We'll be looking at this base scenario and alternatives 1, 2, 3. So the first thing I want to do is I want to put in place that scenario function, which is equal scenario, left parenthesis, highlight those 5 values. Okay? So it's going to show 675 there. Okay, when I hit enter. And I can drag that formula down, and that's what it would look like. Okay? We have some projected inflation rates that we're going to use. This will be for CPI is for inflating the family living expenses, okay? The base draw on family living. This PPI is going to be the inflation rate that we'll use for all costs, fixed costs and variable costs and harvesting costs, production costs. And then there's that prime interest rate, okay? So we have some projected annual prices here for corn and soybeans. Those are the 2 crops, and we have corn and soybean yield. And we have some historical data here. Okay? So, first thing we need to do, step 1, is we're going to develop a multivariate empirical probability distribution that's percent deviations from trend to simulate prices and yields. Okay? And the way we're going to do that is we're going to use the 1-step method here. Don't do it in homework. You've got to use 2-step method in homework. Okay. So it's equal MVEMPIRICAL, multivariate empirical. Okay. Now, when you use that, I don't even remember all the parameters it needs, so we're going to go up here and use f of x. It says we need the values. So I'm going to highlight these values here, and we'll press F4. So I highlighted all the historical data for those 4 variables. Then it asks for the forecast for those variables. Well, the forecasts in the first year are right here in row 53. So I'm going to highlight those. And then it asks for the calculation type. Okay? And we're going to use a 2, which says it's a percent deviations from trend. Right here. Percent deviations from trend. Okay? Now, don't click OK. It's an array function. So hold down Control, hold down Shift, and press Enter. Okay? And if you did that right, you'll be able to drag that down like this. And we have the information for all 5 years that we're going to be simulating. Yes, Abby?
Why does mine not have the calc type?
Did you type MP, EMP, or MD, EMP?
MP.
Oh, the reason why, Abby, okay, hang on. The reason why is you click that. See this bar over here on the right-hand side? Drag it down. Gee whiz. At least she asked a question I can answer. Okay? That's good. Okay. I appreciate questions like that. Okay. So, and then hold down Control, Shift, and Enter. Okay? And drag it down. Everyone there? Good. Now, this is fairly complex. If you get stopped, stumped, delayed, anything, stop me. Okay? Hank. First one, Hank.
Mine's good with values. Yeah, mine too.
Well, that's the problem for you then. Okay, did you highlight all of the values? Okay. Okay. So let me just do it over. Equal MD, EMPRICAL, left parenthesis. F of X. Okay. Did you highlight all of the values just like that? And press F4. And then the forecast values are up here, right? Got that? And then we come down here to calculation type, and put in a 2, and then Control Shift Enter. Did that work for you now? Huh? Got it. Okay. Yeah, there are just some minor things that you can do wrong there. Okay. But I've checked this matrix of data, and it's not supposed to give you pound values if you do it right. Okay. Now, before we go into the calculations that are down here for, what's up, Abby? Huh? God, no. We can't get the same numbers. It's stochastic. We have 46 different computers here, and okay. If everybody had exactly the same numbers that I've got right now, I'd give everyone an A. We walk away from here and be like, we go to Vegas, okay? The odds of that are like 1 in a trillion, okay? Now, anyway, we've got to have some fun at this thing, or we'll lose our minds, okay? Before we go very far, I want you to go over to the finance worksheet. Yes?
Sorry.
No.
So if after pushing F9 a few times, should I be getting zeros?
No, not. Most people don't get zeros. All the time or every time or what?
Pretty often.
Hit expected value and see what you're doing.
My last names are wrong.
What?
I had one of them wrong. I did something.
You only had one wrong? Okay, good. Okay, Good. Now, in finance, I have a table here. And this is, I'm going to teach you a new term. It's called case programming, CASE. It stands for copy and steal everything. Okay? Now, you will find later that you need this table for your homework. And so you will copy it and paste it. Not as values, but paste, okay? It's also in Lecture 20 Finance worksheet, okay? So what we're going to do is click on this A6 and go ahead and say equal, and go back to our model. Up at the top, we have a loan that we have borrowed some money on. So that is going to be B35. Okay? That's the amount we borrowed. The number of years on that loan, the life of it, equals, then go back to model. The number of years is B37. Annual interest rate. You click in there and say equal. And then the annual interest rate is there in B36. And then you move over to the first year of the loan, and that's equal to model 2015, which is in B38. And if you do that right, and we all get the same answer here, by the way. It's not stochastic. Okay. This now gives us everything we need to know about amortizing that loan. Do it this way. Don't do it any other way. Okay? Now, the first year that we have to have information for is 2018. Okay? We need to know how much debt we're going to have on January 1 of 2018. Okay? So in K13 there, I'm going to say equal. And we come over here to 2018, January 1st. Okay? Which is B15. Okay? Hit enter. That's how much debt I have. Now, the interest I'm going to pay. Now, how many of you have used VLOOKUP? Anyone? How did you guys get to be graduate students? Okay, now, here comes. Yes, I know. It's okay. Equal. VLOOKUP. And you can type V formula because about half the time I get excited and type V formula. Okay. VLOOKUP. Okay. We're going to hit F of X. Okay. It says, I want you to look up a value. And so I'm going to say, look up that value there, 2018. Okay. And I'm going to hit F4 twice to lock that row. Now the table or array I want it to look in is this thing here. And it's going to come down here and find 2018, and then it's going to come across here and pull a number out here based on the column I tell it. No kidding. This is really useful. Okay. So the array I'm going to use, I'm going to just highlight the whole thing because who knows, he may change his mind. And I'm going to hit F4 on that because I'm going to use that same array function for all the years and all of those variables. Okay? Now the column I want to pull out of there is interest, and that's column, okay, let's start counting columns. 1, 2, 3, 4. So if I put a 4 right there, okay, everyone with me? And I hit enter, it gave me $34,702, and that's how much interest I've got to pay. And if I did it right, I can drag that across. And so it tells me that in 2022, I have to pay $29,890 in interest. Anyone get the same answer I did? 3, 4. That's 10%. Oh, we're almost up to 15%. Okay. Now, look at it. Here's what it's doing. It says, give me this number here. And I will look down this column until I find it. And then when I come across to the fourth column, that array, and it will give you that number. Okay? And if you get to year 2022, it'll give you the number over here. Okay? Guess what we're going to do? We need to know the principal that's being paid each year, and the principal is in column 5, like that. You hit enter. And guess how much? We need to know how much debt there is in the very last, on December 31st. And that's in column 6. You got it? Everyone there? Okay, good. Now we should be able to drag those two numbers over to the right. Now, the reason for doing this is we have to have those numbers after a while to go into our cash flow and our income statements. Mason, what?
Did you do the same thing for the debt on January
31, of course. I did just like that.
No, I mean for January 1st, where we just put...
No. I only need it one time.
Oh, okay.
Because that will tell me how much my beginning debt is. Okay? Now, I got to have that because I need net present value later. Okay? So that's all I need on that table. Now, on your homework, you're going to take this table here, and you're going to have 2 of them. One for the land debt and one for machinery debt. Okay? And you'd still use this same VLOOKUP over here to make life easier later. Okay. Now, the beautiful part about this is I can change the year that I start simulating to 2020, and it will automatically update this because this 2018 is a cell reference back to the input, and 2019 is just 1 plus that. Okay? Lazy people find ways of doing things faster. Okay, now, let's go back to our model. Now we start into actually farming. Okay, we need production, okay? Now, I wrote out everything you need to know on the side here as to what variables and what the formulas are. Okay, I'll talk about some of those tomorrow in class. So our stochastic production is equal to planted acres times yield. Okay? So we can come over here and just for a moment, we can put in planted acres. And those numbers for planted acres are equal to that number up here we put in as a scenario, B42. Okay? And then we can drag that down, and so that'll be planted acres for 2 different crops. I'm going to say equal G formula on that. Just so we see that that's 42 and the other one's 43. Just happen to be the same number. Okay? So, corn. We have yields and we have prices, right? Now, I've got a problem with that. Okay? I've got the stochastic values going up and down right here for years, and I've got the rest of the model going this way, right? Hank, how do you fix a problem like that? Right! Okay, we're going to come right over here and go to Simetar and matrix operations. And we're going to transpose. You just type trans and it will do it for you. We're going to select this range. We're going to transpose the whole thing. Just like that. I'm including output. A label. There's my transposed data. Haha. Good deal. Now, get rid of all those surplus digits. Now, I have corn yield I have soybean yield. And we're on yield basis, row basis. So I can just do the following to calculate production. It's going to be the stochastic yield for corn multiplied by the planted acres. And I've only got 1 year of planted acres, so I'm going to lock that with a column, H85, $H85. Okay? And if I drag that across, it will give me stochastic production. Now, Abby, just to make sure we're all together on this, I'm going to go to expected value mode. And then we should have the same answers. Okay? Right? Now, let's do the next thing. Let's just drag that one down. Now, if we get our stuff correctly, we should have soybean acres here multiplied by soybean yield here. Everyone got that? Yeah. Okay. This is the nice thing about Excel. And when you drag a formula down, it's good to check the first cell and the last cell that you drag to make sure the formulas are going where they're supposed to. So I hit F2, and sure enough, I'm using soybean acres and the yield in 2022. Okay? I need a localized price. So I need a price wedge. Okay? And what I'm going to have is, I'm going to use a formula that says equal a stochastic price. Well, it's right there. It's stochastic price plus the local price wedge. My price wedge equals, and if we go up there and look for it, we'll find it, price basis right there. It's B32 is the corn price basis or wedge. And so it's 10 cents over the national price. And soybeans is a nickel over. Now, to get my stochastic values, and just to remind myself what these are, I'm going to make those bold. Okay. So my stochastic price for corn is going to, local price is going to be that 311 in expected value plus that wedge. I'm going to hit F4 on it and lock it down to $H89. Okay? And if I drag that down and then check it, it should be the soybean price in 2018 plus the nickel. And we can highlight those and drag them across. Now, and the order in which all these come in, it's pretty well up to you. You can do, just do it in logical order. You can't calculate receipts before you have production, okay? You can't, they're just logical things you can do. We can calculate receipts right here at this point, but they're actually prepared for us down below, okay? We have family withdrawals. So this is the base number that came from B11, okay? And what are we going to do? We're going to inflate that with a CPI. So we're going to take equal this 40,000 times left parentheses 1 plus the inflation rate, which is 0.05. And that inflation rate came from up above. That clear? Now, here's where some people get a mistake, is they try to then multiply 40,000 times 1 plus 0.07. That isn't right. Inflation compounds, okay? So we need to drag this formula across. Oh, and by the way, we should be putting the formula on everything, so just drag it down like that. No, that didn't like that at all, so let's find out. Oh, yeah. Wonderful. So we need to edit that formula and just drag that blue cell over the top of the 42,000. Okay. And then I can drag that formula across. And we should all have 49,575 at the end. Is that right? Now, these are the variable costs that were up above. And to speed this up, so we can actually finish it in an hour and a half, I brought them down here. Okay? And this is something you should do yourself. Okay. Now I'm going to use one inflation rate, and it came from B48 up there. It's a prices paid index, and this is a percentage change from that for 2018 over 2017. So I should be able to just say equal for corn per acre cost of 165 times left parentheses 1 plus this inflation rate. And I'm going to lock that inflation rate because I know I'm going to drag it down. Okay? So it'll be a $D.98. Make sense? Okay? Now, let's drag this formula over here and then we'll edit it because it's going to come up pound value. Okay? So I'm going to move that blue box over the top for 166.65. Everyone there? Don't get behind, please. Okay. Now that formula should be able to be dragged across like that. And okay, now, same type thing, I should be able to drag this formula down all the way to there, to 110, row 110. And I'm going to come back and delete the zeros out of that. Okay. Now, this formula here, we want to kill it. We're going to fix it in just a minute. So, it says that my cash rent is going to be $101, $103.5, $104.46, right on across. Okay. My fixed cost for the whole farm, again, because it's in dollars, we should put a comma on it. Okay. Now, the cash rent, total, we rented 1,110 acres. So I should be able to just calculate the total land rent cost is equal to this 1,110, hit F4 on it, times the 101. That's a rent per acre. And then I'll drag that across. Okay? So that's what I've got to pay for rent. Now we have that national interest rate right there, 0.048, and I know what the local wedge is, so this will give me my localized interest rate, and we'll just say for operating loans. Okay. So again, I'm going to click on that wedge, F4. I'm going to add it to the value above, which is the national or prime interest rate. Yes? Which step, Christian?
Oh, you mind just scrolling up just a little bit?
Thanks for telling me, reminding me. Okay. Now. Are we all together right now? Now's a real good time to hit save. Okay. Next step. This is an income statement. We've all seen income statements before. Now you're going to build one. Okay? Yes?
Can I say before we go to the last part?
For which part?
The last part you
Oh, okay. Okay, I just, and hit F2 on it. F2, there. I just added those two together, the wedge and the national interest rate. Does it come through?
Yeah.
Okay, yeah. Anything else before we go further? Okay.
Dr. Richard,
Yes, Mason.
on land rent, it says land rent not inflated. Is that you're
It's,
inflating it?
I did, just for right now.
Oh,
Okay, let's change out that not inflated. Okay? Land rent got inflated today.
I just wanted to make
Yeah.
sure. It would say that you're just.
In the homework, I think it says don't inflate it. Okay. Now, in reality, land rent goes up and down based on market supply and demand forces and what the little old lady who owns it wants. Okay? She may have signed a 5-year rent agreement in constant, and, you know, and truthfully, that's her living income. It may go up by the CPI. Okay, so it can go up or be flat. It's whatever we want to do with it today. Yeah, that's a good point. Okay, corn market receipts. Okay, this is really a no-brainer. This is price times production. Okay, so equal. We'll go up here and find our local price for corn. There it is in B89. And I'm going to multiply it by the production. Happens to be in B85. Okay? If I hit enter, I get $325,159. And I'm going to drag that across and drag it down. Why did I drag it down? Because soybeans are, if you organize your model to where you've got corn and soybeans every time, then you can take advantage of this. Now, on your homework, you're going to simulate 10 years. How much harder is it to do 10 years and 5? You just drag them in twice as far. Okay? Excel is really nice. Okay, we're going to sum those two numbers, find our total receipts. Now, on your homework, you've got some other receipts in there. I can't make it easy. Okay, it's just not in my nature. Okay, so we need corn variable cost of production. Okay, this is that production cost. Okay, so it's going to be, I'll just make a note over here. It's acres times dollar per acre. Okay, and this harvest cost is going to be dollar per bushel, which is a yield unit, times production. Okay, so variable costs equal. Okay, let's go find it. We have, there's planted acres, and it's a fix, so I can lock that column, H85. I'm going to multiply it by the inflated cost of production per acre, right there, which is D101. So it's inflated cost per acre, so $166 an acre times 675 acres. Okay? So it's $112,489. And if I drive that down, I should get $52,000 because that's for soybeans. They're cheaper to grow than this on this farm. And we drag that across. Okay. Now I have corn harvesting costs. Okay. This is going to be production times the cost per bushel. So equal dollars per bushel. And we have that harvest inflated corn harvest cost per bushel. Okay. And we multiply it by production. And I have corn production in B85. So my formula looks like D104 times B85. Everyone agree? Okay. It should be 39,445. Drag it across for 5 years. Drag it down. Okay. Land rent. Okay, well that's a no-brainer. I just saw that a minute ago. Okay. That is equal to D111. Okay. And we can drag that across. And fixed costs are equal to, okay, we inflated that a minute ago. There it is. It's in D107. Okay. Now, drag that across there. Now I'm going to sum these. So these are my variable and fixed expenses. And it says sum of the cash costs. So these are out-of-pocket cash expenses that you have to plant a crop and harvest it. Okay? Now we have to calculate operating interest. Okay? Now, the operating interest is the local interest rate times the sum of cash costs times a fraction of the year the loan is used. Okay? Now that fraction of the year that the loan is used, okay, that's just a number that's up there above, and so we need to go find it. Okay. So if we go looking, it's going to be in the yellow section. And operating loan as a percent of the year. Okay? What this amounts to is farmers use an operating loan that's on a line of credit. They don't borrow $100,000 and keep it for 365 days and then pay the interest on the loan back at 365 days. They borrow a little at planting time, a little bit more when they fertilize, a little bit more when they irrigate, a little bit more when they harvest. And as soon as they sell one crop, they start paying off that loan. Any business person is going to do exactly the same thing. It's a rational thing to do. Okay? So after many years of interviewing farmers all over the nation, I've come up with a number of 0.66. And that's just pretty standard for crop farmers. If you're a dairy farmer, the number is about 0.1 because they get a check every month for the milk. Okay, so they're not borrowing for a year. Cow-calf operators, they borrow for 399 days. Oh, you can figure that out. Okay, B17 is the number we want. Okay? So go back down there and we'll calculate this. Okay? Did I say it was equal to B19? No, not. B what? 17? Okay, just to make sure it's there. Okay, I'm going to take that and I'm going to multiply it by the sum of cash expenses. Multiply that times that local interest rate that we've identified there in B116. Okay. I'm going to drag that across. Okay, land debt. Now we have to pay interest on that, and one way we actually calculated it, didn't we? So let's go equal, go over to finance, and there's that interest in 2018. It happens to be in K14, isn't it? Okay. So I can bring that over as land interest, or the debt from the land interest. It says it's in the finance worksheet. Now, right now, we do not have any carryover debt. It didn't say at the very beginning up there that we had a carryover debt, okay? We might have had one, but we didn't today. This row here, I want you to highlight it in yellow. That means we're going to come back and fill it in after a while. We don't know what to put in right now, okay? So our total expense is equal to the sum of cash expenses plus interest and carryover debt interest. Okay. Now,
How's your operating interest blank for?
I don't know. Oh, I know. I didn't hit F4 on that B17. Thanks, Jeffrey. Okay? No, my banker didn't die and give me a fortune. Okay. Wow, thanks. That would have been a problem. Okay, now, net cash income. This is the hardest one of all. It's equal to total receipts minus total expenses. Okay? So, if we've got similar numbers at that point, we're really doing good. Okay. Now we can go into the cash flow statement. Okay. The beginning cash, I plugged that in. It came from cell B10. It was an input value up there. Remember? And we don't know what to put in here for these cells, so we're going to paint them yellow. My net cash income. So I'm going to have all my inflows of cash right here. So it's equal to that number up there in B138. Okay. We'll drag that across. I have interest earned. Okay. And that's equal to how much cash I have at the beginning of the year times my interest rate on savings. So it's equal, oh, don't do that. It's equal to that 65,000 times, and way up there we saw that interest rate a while ago. There it is. Interest on cash reserves is B18, and hit F4 and lock that thing in. Okay? So it's the beginning cash that you have times $B$18. We'll drag that across. And then we need the sum of cash flows, inflows, equals sum of those three values. Now, if you have other income from other sources, you could put that in here as well. Okay? to have principal payment on the land debt. Okay, that was over there in the finance section. So we can go equal finance. And there's that principal payment that we did with a VLOOKUP. It's in K15. We can draw that across. Now, I didn't have any beginning debt, so I don't have to repay it, so I can put in 0 there, or blank. And we don't have a number to put in here yet. Okay, so we're going to paint that as yellow. We're in family living. It's equal to, remember we inflated family living up here. There it is, family living, family withdrawals. It's D95. And I can drag that across. Now I have a bonus. Remember there was a 5% bonus? So it has to be an if statement. If, spell it right, James. If net cash income is greater than 0, then I'm going to take net cash income and multiply it by a fraction. That fraction is way up there in the yellow section. Where's that at? Family living.
5%.
It's 5%. Oh, there it is, right there in B12. So I'm going to hit F4 on that, comma 0. So if it's negative net cash income, we want to have a 0. If you don't, what you're doing is you're taking money out of your pocket and putting it back in the cash flow statement when it's negative. Right, Princess? And drag it across. Okay. Income taxes. Oh man, this is like April 17th all over again. Okay, so what we're going to do, again, case programming. We're going to go over to taxes. This is a little worksheet that I made up a long time ago, but I updated it the other day because we now have what is called Tax Cut and Jobs Tax Law. Okay. What we have is a real nice thing here. This is built for 10 years because you might want to use it for 10 years. So we need net cash income, and so we're going to say equal, and we go back to the model. We can click on net cash income in B138. Okay. We're going to drag that across. And there's the zeros out there. So we don't want to drag it past year 5. Okay, interest earned. So that's equal. Go back to the model. We're at $195. Big deal. Okay. And we'll drag that across for 5 years. And while I'm at it, I'm just going to delete these years 6 through 10. Depreciation and other deductions. Okay, in the input data, over here, way up the top, I gave you some income tax deductions. There's depreciation is B14 and other tax deduction is B15. So I'm going to click on just the depreciation and I'm going to drag that down for B15 so I've got that. Then I'm going to tell these numbers here, year 2's numbers equal to year 1's number. Like that. And what it's done is calculated my taxable income here. It ran that taxable income through a monster VLOOKUP table here, and it calculated the income taxes due in row 26. Okay? Just for the moment, I'm going to hit save, and I'm going to turn off expected value. I'm going to show you what happens. So, as income changes, our income is stochastic up there, my income taxes change. Okay? Now go back to expected value. Go back to your model, your cash flow statement. And it says income taxes. So we're just going to click equal, go back to the taxes worksheet, and get income taxes due on row 26, okay, in year 1. Okay. Now, we have annual machinery purchases. And this is where things get a little bit complicated. Machinery is the worst thing you can model. I'll just tell you up front. Because technically you should you should keep record on each machinery item. So if you go to a typical farm, they'll have 100 pieces of machinery. So you've got to keep track of it. When it was purchased, was it new or used when it was purchased? What was the purchase price? What's the replacement cost for it today? How long are we going to keep it? Okay? And is the new stuff going to appreciate at this rate and the old stuff going to depreciate at this rate? Okay? And then are you going to trade it in? It's just short of a total nightmare. So what we're going to do up here is we're going to demystify that just a little bit. Okay? We have to purchase $65,000 worth of equipment every year. Okay? Just to keep the farm stable. And we're not going to worry about trade-ins and all that. Okay. So, and we have an initial value of machinery, I think. Someplace we should have a beginning value of machinery. Is there one there? I don't see it. Should have been in assets. Well, okay, we don't have one. Let's insert a row right here. Okay, so I'm going to have a row. This is the initial value of machinery. And let's just give this 1,100 acres. I'm going to give it $300,000 worth of equipment. Okay. Now the reason I'm going to go into this in a little bit more detail is because this is a big sticking point that you will have with homework. Okay? And I need to show you how you're going to handle that. Okay. For the moment, I'm just going to do this right here so we can see it. So our first year is, we're going to say equal the year 2018 equal 1 plus that year I'm going to drag that over here about to there. Okay. Now, we have machinery, and I'm going to inflate that. Okay. This is going to be an inflation rate for used equipment. Okay? And that's going to be minus 0.09 that year. Well, I'm having a hard time with that. it's not quite what I wanted. 0, 9. Okay. So it goes down 9% that year, minus 0.04 that year, and we'll just keep it at 04 from there on. Okay. For new machinery, let's take it up at 0.07. So that's going up 7% every year. So this is my machinery that I had on the farm. So I started with, that's $300,000. Okay, B8 times references 1 plus the minus 9%. Okay, so it went down about $27,000 that year. The next year, I'm going to have that $273,000 times references 1 plus the minus 0.04. Okay? So that equipment is going downhill in a hurry. Okay, now I'm going to buy new machinery, and the cost of that is equal to that $65,000 times references 1 plus that 7% that first year. Okay. So really, I might have thought I was going to spend $65,000, but that's in real terms. In nominal terms, I have to spend $69,000. So the next year, I've got $69,000 times references 1 plus this value up here. Okay? Everybody see that? So I got $74,000 that I actually have to spend to buy machinery that year. Now, the value of asset, or the asset value, machinery, and if I tell it that, there, is equal to what the used equipment is plus what I purchased. Okay? We're going to make you purchase that outright with no machinery loan. Okay? So while we're right here, we know how much we're going to have to spend on the cash flow statement, and we know what the asset value of our machinery is over time. Okay, those are two things that we have to have. Another thing we have to have for an asset is the value of land. Okay, so let's just update that. So land value. Okay, we have $1 million worth of land, and it's being inflated at 5%, about 0.05. And so the next year, I'll use $1,050,000 times references 1 plus that B10. And that time I'm hit a 4 on it. And I'll be able to drag that formula across. Okay. So there's significant madness in what I'm actually doing here. Okay. So these three values here are going to be, well, are going to be very important in just a minute. Okay? So I'm going to bold them just so I remember them. Now, I wouldn't suggest putting this stuff up here in your model. I would put it down below in the calculations where you do your inflation or variable costs, etc. I did it right here so we wouldn't have to be going back and forth. Okay. The nice thing about Excel is we can do all this work here where it's handy, then go down and open the spreadsheet up, add rows and copy and or cut and paste this into wherever we want it to go. Okay? Now, let's go to the next step. Okay? And right about here, see this View tab? Okay? If you go to View tab and you click on it, yes, Joe. No, yeah, Joe.
I just was wondering, is there a way you can make like the land value change stochastic so it changes between the 5% down to?
Yes, you can. You could, yeah. Man, we'll work that into one of your problems. Okay. We can do a GLKS on the inflation rate on land each year. So each year it can go up and down, and, yeah. If you have time, you can always do it yourself. Okay. If you will come in here, right about here, at row 13A, and click that button right there. Okay, I want to view and split. Okay? Now, I'm going to go all the way down here so I can still see that stuff up there. I'm going to use it for cell referencing. So, down back into my cash flow statement. So, if you're schizophrenic, this works really, really well. You know, you're in two different worlds at one time. I actually had an employee who had 16 personalities. Okay? If you don't think it was interesting coming to work those days, you wondered who came to work. Okay, now, back in here. Okay, I'm going to go equal machinery purchases, and this is when I'm going to buy new machinery. So 153 for me is equal to E10. Okay? I'm going to drag that number across right now before I forget it. Okay? Now, I have land. I don't know why it's here. It shouldn't have been. I'm going to just do what needs to be done here. Land is equal to, and I'm going to click on that value up there. And it happens to be the same one, so we did it right twice. I'm going to have to insert. I'm just going to move this word total assets down, and I'm going to put in machinery value. Okay? And that's equal to this asset value of machinery that I had in E11. Okay. And so that was buy, that's buy. Okay, those are my three numbers that I needed to bring down here from that. Once you've done that, okay, hit F2 to make sure you brought them in correctly. Okay, now we can double click this, or we can click back the split, and you're back where you were. You've got one screen, one personality. Okay, now let's work this cash flow statement out. Equal the sum of the outflows and drag that one across. Then we have ending cash, and that's equal to our cash inflows minus the ending cash. And that's B154. Okay. and you drag that across. Now, wonderful, we got negatives, okay? That's good, okay? Now, this is where the most complicated part of this whole thing gets, okay? Cash, beginning cash, asset cash, that means it's positive. A negative cash is a liability, okay? Please remember that. Okay, equal if this ending cash is greater than 0, then let's use it. Otherwise, put in a 0. Yes?
Why would you not take the ending cash on December 1 and move it to the beginning cash on January 1 for next year?
Well, it would be. It is. Okay. Okay. No. Just hang on. It'll work. Okay. Trust me. Okay. Okay. So this is my cash. And if I can click on drag it across. Okay. Now I have total assets equal to sum of those assets. Laying debt. Okay, we did that a while ago. It's over in finance, right? And this is the debt that we have on December 31. So we go to finance, and debt is in K16 over there. Drag that across. Now, if this cash flow deficit is an if statement, equal if this ending cash here is less than 0, then take minus that number, otherwise 0. The minus is extremely important right there. If this value here is negative, then take a minus of it, because now it's a debt, okay? Or put a 0 there. And then we'll drag that across, and we'll get that. We can sum this, these two liabilities, and we can calculate net worth is equal to assets minus the liabilities, which is B166, and you can drag those across. Now, we still have some yellow lines up there, okay? And what we have to do is the following. We're going to take care of this beginning cash first. Now, beginning cash, okay, by the way, the yellow lines here, I'll give you some more yellow lines. This one's considered yellow because it's difficult. And this one's considered yellow. On the lab exam, each yellow line is worth 5 points. How many of them are there? There are 5. You can lose 25% of the exam on those 5 equations, because that's what makes us different from any other business. Okay, now, this beginning cash here is equal to an asset down here. This beginning cash is not that number there. It has to be this one coming from the balance sheet, because until it's positive and comes from the balance sheet, it's not yours. It's not cash. Okay? And you drag that across. Okay. Now, where does this number come from? Okay? This is a deficit. These numbers down here in this row are liabilities. The only way you can go from one year to the next with a deficit is if you get a short-term loan and the banker wants that repaid. Okay? So I'm going to repay that loan. It's going to be equal to that cell there. So repay the deficit loan, so it's equal to that. So I come in, drag that number across. Now apparently I slipped out of, no, I'm still expected value. Good. Okay. Now we have 2 years that are deficits at this point. Now remember we had one more row up there. Okay? When you borrow money, the banker wants you to pay interest on it. Anyway in my world. Okay. So, I've got to pay interest on the deficit. In year 2019, I'm repaying the loan from 2018, and we'll pay interest on that 20. Okay. You got the picture. So I'm going to go find my interest rate. And it says interest rate, operating loan interest rate right there in C117. And we'll multiply it by the amount that I had to borrow because I had a deficit. Okay? Right there. So it's C117 times B165. Just like that. 117 times B165. And in the base scenario for your homework, you're not going to have a cash flow deficit. So it's up to you to go F9, stochastic, until you get a negative ending cash, and then make sure those equations line up correctly. We'll go over this again in class.
I got lost in the repay deficit loan.
Okay, let's do that again because it's really, really important. Okay, so when I'm repaying this loan here, it has to come, it's this loan here. In 2018, I repay it in 2019. Now, where I've seen many people make a significant mistake is they will try to repay it in the same year, and it will create a circular reference. If you get a circular reference, just shoot yourself. Okay? Just, hit escape. As soon as it says circular reference, hit escape and don't go further. Delete that cell and then figure out what you did wrong. Because what you're doing to get a circular reference is you would say, if I say this is equal to that number there, it's going to say circular reference. Oh my gosh, you've committed a major sin. Okay? This is like number 1 sin. Don't do it. Hit escape. Okay? And then as soon as it shows you blue arrows, hit delete. Okay? Then you're okay. But circular references, if you go more than one step, with load Excel, if you went more than one step past that, you could never undo it. You just couldn't figure out where you were at. Okay. So right there we have a model. Okay. What else do we need to do with this model? Well, we need to calculate beginning net worth. Okay. We have beginning cash. We had land values and buildings at $1 million. And then we had, we need to move these two down just one row. We have machinery now. Okay. And that was equal to that $300,000. Okay. And it's in B8. Okay. Now, remember in that finance we got 1 year's debt on January 1, 2017, and it's equal to, go to finance, and it's that debt right there in K13. Okay? So my beginning net worth is equal to cash plus land plus machinery minus that debt. Okay? Now, I need to calculate the present value of family withdrawals. Okay? So that's going to equal the sum of those two family withdrawal numbers that we have up here. The sum of these two values here, parentheses, times a discount factor, which is that number right there. And we'll talk about that number in just a minute. Okay, so that's the present value of family withdrawals in year one. That takes everything back to year 2017 nominal, okay, or real, I guess. And we'll drag that formula across here. Now, how do I get to 0.89? I've got a discount rate in B14. 1 divided by 1 plus the discount rate raised to a 1. This one's raised to a 2. This one, of course, is raised to a 5. Okay.
Can you redo that family withdrawals for 1 second? Sorry, I got.
Oh, no problem at all. It's a sum of 150 plus and 151, which are right there in the cash flow. Sum of those two times that discount rate factor. It's a factor at that point, it's not the rate. Now we also want the present value of ending net worth. And that's equal to this ending net worth here in 167 times that discount rate. Okay. Now, we need to calculate net present value. And net present value, the formula for it is the following. Is equal to minus the beginning net worth plus the sum of the present value of family living plus the present value of ending net worth. And that's that formula you need to memorize. Okay? So we start it with minus that beginning net worth. And see, that's why we had to calculate that debt at the very beginning of January 1. Okay. I'm going to add to that the sum of these family withdrawals in present value terms. I'm going to add to that the present value of ending net worth. Okay. And it's minus $77,000. Yes. So it's minus the blue plus the red and the purple. Now, the present value of ending net worth, the PBENW, is equal to that number right there, 635. We've already calculated that. And this is a KOV table. For right now, we'll just put in present value, net present value. Okay? Now, we've all got to this point. Hit save. Okay. Now, let's go to simulate. Then I'm going to turn off expected value. We're going to simulate. I'm only going to simulate one value, this one. Label left, add, until we have 4 scenarios. Okay. Everybody ready? And then we're going to simulate. And this is going pretty fast. Okay, we have 4 scenarios. We've got negatives here. Now, how close are we going to get to each other? We should be within $1,000. Okay? Now, what can we do with this? Well, the first thing you can do is you can draw a CDF. So we have 4 CDFs in one chart. And voila, they're all crossed. So we can't use first degree stochastic dominance, can we? Okay. So we could try stochastic efficiency. So I'm going to highlight those 4. Labels, add. Now, when I first run Stoch, I'm going to put in a reasonable upper risk aversion coefficient of 0.3 zeros and 1. I can always experiment with it afterwards. So, okay. Now, when you see a picture where it goes down like that, that's not a good one. So you change this upper left to equal 4 divided by that beginning net worth for that farm. So I'm going to go back to model, and I'm going to beginning net worth of 904,000, 902,000, and it gives me surf chart that looks like this. They're going to slope down, but they don't go negative rigor. We don't want it to become a asymptotic to an x-axis. Okay? Yes, Christian?
When we ran the simulation, we're not within 1,000 of where you're at.
Yeah.
Looks like we did.
You did it wrong. Okay? There's only about 400 equations up above there. Don't know which one. Okay? Now, next thing we can do with this is we can run a stoplight. And cells, add. 0 is always a good number to put in for the bottom on the net present value. Just pick a number, 100,000, because once it's run, then we'll change it. Okay, wow, that's 66% chance of being negative. That's not a good farm. Okay. The what? How did I do it? I just plugged in 100. Here's what I recommend you use. For the bottom, I'm going to use the 25th percentile. And for the upper, I'm going to use the 75th percentile. The way I'm going to do that is I'm going to say equal average. I'm going to scroll down here till I get to row 125. I'm going to take the average of those. And for the 75 percentile, it's going to be equal average. And we'll go down to row 375. And calculate the average of those numbers. And then I'll go We'll get there. Hang on. We're going to say this is equal to what bottom 20 percentile, and this one is equal to the upper. Okay? And it always gives me red, yellow, green, and it's not overwhelming. Now, in actuality, a 0 on net present value is your bottom cutoff. That's where you want it to be, because that is the probability of economic failure. The green plus yellow in this case is the probability of economic success. Okay? And that will be consistent with your CDF that you've developed right here that says you've got about a 65% chance of being negative. Okay? So that's a 33% chance of economic success. Okay? Now, in terms of finding mistakes in this thing, here's where I recommend you look. Don't come and see me. Come and see me if you have a problem. What you have to do, go to expected value and check your total receipts. That's the first place to look. And if you have a mistake there, check in the receipts for each individual source of receipts. Then you go, if your receipts are okay, then you go to the sum of cash costs and you check that. And if you have a mistake there, then find out which one it is. This is the reason I recommend having extensive number of variables here. Don't just have total variable cost for production and total variable cost for harvesting and total of all fixed costs. Have them broken down one at a time, because you get points for having more detail in here, okay? And you can find your mistakes faster, okay? So if you've got a mistake, go find it and correct that one line and then check again, okay? Operating interest, land debt interest, those are very easy mistakes to have. Total expenses, okay? Net cash income, definitely receipts minus expenses. Then you have to check your formulas down here. This is just a direct transfer from here to here for net cash income. Okay, interest earned is a simple formula. Total cash inflows. But if you're looking for mistakes, you either start at the bottom and work up, or you start at the top and work down. Okay. That's the balance sheet will usually take care of itself if you've done the yellow ones correctly. Okay. In terms of building a KOV table, this is really easy. You just say equal trans, and you go up there and highlight the ending cash. And this is the one you want. Control Shift Enter, and then net cash income. Now, one thing I recommend is that you use short names for these variables that you're going to send to Simetar, so that you can actually read them in the little column space that you get. If you use net cash farm income, it's going to be this one. You're not going to know what year you're in. You have to count across. Okay, do it simple like that. Another thing you can do, okay, when you've got 4 scenarios, you've got a lot going on. Okay, you can come back here and take it off of 4 scenarios to just go to 1 scenario. Clear out all of that. Label add, and send it to send database. Okay? And so it's going to run the first scenario, stochastic, for all 10 of those variables. Well, I have ending cash and net cash income, and you can trace those out. Now, if you can't find your error in expected value, then you have a mistake in your stochastic variables. Okay? So if your expected values are working, then check your stochastic. And remember that when you're doing multivariate empirical distributions, they're not symmetrical, so that our expected value here doesn't necessarily equal the mean that we looked at up here. Notice this coin price, we've got 311 down here for the expected value. Even though we gave it a price of 322 up here, it's because that distribution is skewed. With an empirical distribution, you don't have skewness left or right. Okay? Now, I'm going to tell you to pat yourselves on the back because I haven't had a class go through this lab in an hour and a half in a very, very long time. You guys did really well. I don't know how many of you finished it, but you did really well. Okay? Question?
For one thing, for the present value of the family withdrawals, could there be like an issue just with the discount factor? Because I'm off on my last one, but just by a little bit from what you got.
On that number,
It's just that one number, that one, and then the present value of any network.
we use these values here, right?
Use those right there.
And you're off there.
What's that?
Well, what's your family withdrawals up here, Mason?
It's the same as 42. Oh, on that one, let's see. That one. Got 49.
7649?
That one got off a little bit.
Okay, that was at 5%. So that means your net cash farm income may be off. Look at that one. 152, 985. Okay.
So it's just that last column I got a little bit off.
Okay, where that usually happens is up here when we're doing these inflations, and some of them are starting over here in column B, and everything else starts in column B. You can make so many mistakes there. Okay.
That makes sense now, though. I was wondering why it was just that last column that was getting off.
Okay, that can do it. Joe,
Somehow my income taxes are wrong.
your income taxes are wrong. My gosh, you didn't pay your accountant enough, dude. Okay, let's go find out. Okay. Do you have that?
Wrong starting in 2020.
What?
Don't be wrong starting in 2020.
Okay, 18, 19, 20. You're
I have 32,448 for year 2, but then my year 3 is 24,000. I don't know why that's happening.
okay, now wait. What are you talking about there? If you got taxable income the same as I've got here?
Yeah, until year 3. Which D
Year 3.
comes down.
Okay, year 3. Okay, which is wrong? That number, that one, or that one?
The other deductions.
Other deductions, how can it go down? It was 4,000 every year. Oh, it could be 0 if you didn't lock it.
No, for some reason I must have actually, I figured that somehow I actually put all the numbers in those other
It's so easy to do. Okay,
that was all I got to know.